In the early 1920s, Germany faced a crisis that few modern economies had ever experienced. It did not begin with empty shelves. It began with paper. After World War I, the German government was burdened with massive war reparations under the Treaty of Versailles. According to historical records, these payments were denominated in foreign currency in gold, not in German marks. At the same time, the country faced political instability, economic disruption, and heavy domestic debt. To manage these obligations, the government began expanding the money supply. According to economic historians, large amounts of currency were printed to meet internal expenses and stabilize state operations. At first, the effects were gradual. Prices rose, but life continued. Shops remained open, workers were paid, the system still functioned. Trust in the currency held, at least temporarily. By 1922, however, inflation began accelerating. According to official price indices from the period, the value of the German mark declined rapidly against foreign currencies. Businesses struggled to set prices, contracts became difficult to enforce. Savings accounts began losing value. Still, many believed the crisis would stabilize. Government officials attempted policy adjustments. Negotiations over reparations continued, but the structural problem remained. Money was being created faster than confidence could sustain it. By mid-1923, inflation entered what economists later described as hyperinflation. According to widely cited historical data, prices doubled in days, then hours. Workers were paid multiple times a day, so they could rush to spend wages before they lost value. Reports from the time describe families carrying wheelbarrows of banknotes to purchase basic goods. Savings accumulated, over decades evaporated. Pensioners saw lifetime reserves become worthless. Middle-class families who had trusted the banking system found themselves impoverished almost overnight. According to historical accounts, some businesses resorted to barter. Foreign currency and commodities became preferred stores of value. Yet, even during collapse, certain things endured. Factories still existed. Farms still produced food. Skills did not disappear. The crisis revealed a critical distinction. Money as a unit of account had failed, but the underlying economy, physical goods, labor, and infrastructure remained. In November 1923, the German government introduced a new currency, the Rentenmark, backed by industrial and agricultural assets. According to economic records, the reform stabilized prices relatively quickly. Confidence returned, though the social damage persisted. The lesson was stark. When money collapses, trust collapses first. But what about modern economies built not on paper notes alone, but on digital accounts, global markets, and interconnected banking systems? Nearly a century later, another form of financial collapse would test that question. In 2008, major financial institutions in the United States and Europe faced failure due to exposure to mortgage-backed securities, according to government investigations and court documents. Excessive risk-taking in complex financial products had destabilized the system. When confidence in major banks faltered, markets froze. Credit, the lifeblood of modern economies, tightened abruptly. Governments intervened with emergency lending programs and bailouts. According to reports from the U.S. Treasury and Federal Reserve, extraordinary measures were taken to prevent systemic collapse. Without intervention, officials warned ordinary savings accounts and payment systems could have been disrupted. The system held, but barely. The crisis demonstrated how dependent modern societies are on financial trust. When banks fail, paychecks stall. When credit freezes, businesses close. Unlike hyperinflation, where money loses value, modern collapses can involve sudden illiquidity, where money technically exists but cannot circulate. Each crisis raises the same question. If confidence in money breaks down, what truly lasts? History shows that currencies can collapse. Banks can fail, markets can crash, but societies do not vanish overnight. The deeper story lies in understanding what survives when financial structures fracture and what disappears with them. And as new economic stresses emerge in the 21st century, from debt burdens to digital currencies, the tension between money and trust remains central. The rise of complex financial systems has increased prosperity, but it has also increased fragility, and when fragility meets fear, history suggests the results can be swift. When money fails, it rarely does so without warning. In nearly every major financial collapse, investigators later identified patterns that had been visible but ignored. During Germany's hyperinflation, government deficits were persistent. according to economic historians. Reparations payments and domestic obligations created structural imbalances long before prices spiraled. Currency depreciation accelerated gradually before it became uncontrollable. Warning signs existed in exchange rate data, bond markets, and public finance records. Similarly, before the 2008 global financial crisis, housing prices in the United States rose rapidly for several years. According to the Financial Crisis Inquiry Commission, lending standards deteriorated. Mortgage products became increasingly complex. Ratings agencies assigned high grades to securities backed by risky loans. Leverage within major financial institutions increased significantly. At first, the system appeared stable. Banks reported profits, asset prices climbed, consumers borrowed freely. Confidence reinforced itself, but the mechanism underlying the expansion depended on ever-rising asset values. According to investigators, when housing prices began to decline in 2006 and 2007, mortgage defaults increased. Financial institutions that had purchased or insured mortgage-backed securities faced unexpected losses. Liquidity began to evaporate. In September 2008, the collapse of Lehman Brothers signaled a turning point. According to official records, interbank lending froze as institutions questioned each other's solvency. Credit markets seized. Businesses dependent on short-term financing struggled to operate. The mechanism was not hyperinflation, it was distrust. When financial actors no longer trusted balance sheets, the system stalled. Governments responded with aggressive intervention. Central banks injected liquidity. Emergency lending facilities were created. According to Federal Reserve reports, trillions of dollars in support were extended through various programs to stabilize institutions and restore confidence. The intervention worked, but it came at cost. Public debt levels increased. Political backlash intensified. Confidence in financial elites declined. According to public opinion surveys, from the period, trust in banks and government institutions dropped sharply in many countries. The warning signs were clear in hindsight. Excessive leverage, concentrated risk, complex financial instruments poorly understood by investors, overconfidence during asset booms. The same structural vulnerabilities appear in different forms throughout history. In emerging markets, debt crises often follow rapid borrowing in foreign currency. According to International Monetary Fund case studies, countries that accumulate large external debts face heightened risk when exchange rates shift. When capital flows reverse suddenly, currencies weaken and repayment becomes more difficult. In each case, money itself does not physically disappear. Instead, the value attached to it and the trust behind it erodes. Modern financial systems are more resilient than those of the early 20th century. Deposit insurance protects small savers in many countries. Central banks act as lenders of last resort. Financial regulation has strengthened since 2008 in certain jurisdictions, but fragility remains. Embedded in complexity, according to reports from global financial watchdogs, rising sovereign debt, interconnected banking systems, and rapid technological changes introduce new stress points. Digital banking accelerates the speed of withdrawals. Financial markets respond to news within seconds. The 2023 collapse of regional banks in the United States provided a recent example. According to regulatory filings, sudden deposit withdrawals combined with interest rate risk create a liquidity pressure. Authorities intervened quickly to prevent broader contagion. The episode demonstrated how rapidly trust can evaporate and how heavily systems rely on government backstops. Every crisis reveals the same core truth: money functions because people believe it will. When that belief weakens, cracks appear, but history also shows that societies adapt. Currencies are restructured, banks merge or dissolve, new regulations emerge. The deeper question remains unresolved. When financial structures fracture, who absorbs the loss? Savers, taxpayers, shareholders, workers. Each crisis redistributes wealth in visible and invisible ways. And while currencies can be replaced and banks recapitalized, the social consequences of collapse often linger longer than the financial repair. The next phase of this story is not about numbers alone. It is about what survives when trust fails and what does not. When money breaks, the collapse is rarely symmetrical. During Germany's hyperinflation, according to historical accounts, debtors benefited while savers suffered. Borrowers repaid loans with currency that had lost most of its value. Middle-class families who had accumulated savings in bank accounts saw their purchasing power evaporate. Social resentment deepened. According to economic historians, the destruction of savings contributed to long-term political instability. In the years that followed, the economy did not disappear. Factories reopened under a stabilized currency, trade resumed, but wealth had shifted, trust had fractured, and the memory of collapse endured far longer than the banknotes themselves. In 2008, the consequences followed a different pattern. When major financial institutions faced insolvency, governments intervened. According to court documents and official reports, some banks failed, others were merged, and several received emergency support. Shareholders in certain institutions suffered significant losses. Yet in many countries, depositors were protected through insurance schemes and state guarantees. The system survived, but unemployment rose sharply in the aftermath. According to labor statistics, millions lost jobs in the recession that followed. Foreclosures displaced families, small businesses closed, public debt expanded as governments financed bailouts and stimulus programs. Again, the core infrastructure of society remained intact. Electricity flowed, roads functioned, schools operated, food was produced. What failed was financial confidence, and confidence is foundational to modern economies. More recently, smaller-scale collapses have offered similar lessons. The failure of certain cryptocurrency exchanges, including the 2020 bankruptcy of FTX, demonstrated how quickly digital financial ecosystems can unravel. According to court filings, customer deposits were misused, and billions in value disappeared. Investors who believed digital assets were secure faced sudden losses. Yet even there, the broader global economy did not collapse. Markets absorbed the shock. Legal proceedings began. The system adjusted across centuries. One pattern is consistent. Money is a social agreement. It holds value because societies agree it does. When that agreement fractures, the immediate consequences can be severe. Savings can vanish, contracts can fail, credit can freeze. But the physical world does not evaporate with financial panic. Skills remain, land remains, human networks remain, institutions, though damaged, can be rebuilt. The greatest long-term damage often lies not in the currency collapse itself, but in trust erosion. According to behavioral economists, trust once broken is difficult to restore. When citizens lose confidence in financial institutions or governments, recovery becomes slower and more politically volatile. That is why modern central banks prioritize stability so aggressively. According to official policy statements, maintaining price stability and preventing systemic collapse are considered essential to preserving public confidence. Will anything last when money goes bust? History suggests yes, but not everything. Savings may not survive. Certain businesses may not survive. Financial reputations may not survive. But productive capacity often does. Communities adapt. New monetary systems are introduced. Reforms emerge from investigation and failure. The enduring elements tend to be those tied to real output and social cooperation, rather than speculative valuation. That does not minimize the human cost. Every collapse leaves victims, retirees, who lose savings, workers who lose jobs, families who lose homes. Court documents, government investigations, and academic studies consistently show that financial breakdowns disproportionately affect those least able to absorb shock. The question, then, is not whether collapse ends everything, it is who pays the price and how long recovery takes. Modern economies are more interconnected than ever before. Digital banking, global capital flows, and complex derivatives increase both resilience and risk. Institutions have tools to prevent collapse, but those tools rely on continued confidence. When money goes bust, history shows that trust determines the outcome. Rebuild trust, and systems recover. Fail to rebuild it, and instability lingers. The structures of society, labor, infrastructure, human knowledge often endure beyond financial chaos, but they endure scarred, and every generation inherits the memory of how fragile money can be. If you found this investigation valuable, subscribe to the channel for more fact-based documentaries examining the systems that shape our financial world.